Live from the Ken and Valerie Baker studio at WHYY, this is Studio 2.
On Monday, March 30th. Welcome, friends, on into the program. I'm Cherry Gregg.
And I'm Avi Wolfman Arendt. Benjamin Franklin, we had to start with him. Benjamin Franklin famously wrote, "In this world, nothing can be said to be certain except death and taxes." And sometimes when you do your taxes, you kind of want to die.
Yep.
The U.S. tax code is thousands of pages long, filled with ever-changing rules for deductions, credits, exceptions, subsidies, and much more. And every spring, Americans pull their hair out trying to get the numbers right.
So welcome to the latest installment of our monthly Big Fix series, where we try to solve America's most intractable problems. And today, we're taking on our tax code, and we are asking, how can we make taxes simple and equitable? Can we ensure that people pay their fair share and that the government gets what it needs to provide the services that we all rely on?
And so we've asked 3 tax experts with different perspectives to pitch their boldest ideas for reimagining the tax system. Along the way, we'll cover things like the flat tax, the billionaire's tax, the land value tax, and more.
And we have got a great panel with us. We have Amy Hanauer, Executive Director of the Institute on Taxation and Economic Policy. We also have Adam Michel, Director of Tax Policy Studies at the Cato Institute, and Daniel Garrett, Assistant Professor of Finance at the Wharton School of the University of Pennsylvania. Welcome to the program.
Thank you so much, Cherry, for having us. This is wonderful.
Yes.
Thanks for having us on.
Happy to be here.
All right. And our question for you, our listeners, is this: what would be your big fix to our tax code? The number to call is 888-477-9499. The email is studio2@whyy.org. And for our streamers on YouTube or Facebook, you can drop your comments in the chat.
All right. So the way this works is everyone's brought a couple of ideas with us, and we're going to go through each of these ideas in like a cycle. And we're going to start with Amy. Amy's first idea has to do with fixing corporate taxes. So Amy, lay out the problem and the solution.
Yeah, thank you so much. We just need to make sure that corporations actually pay taxes. And unfortunately, after 2 rounds of Trump tax cuts, they don't. We have seen that corporate tax avoidance is as bad or worse today than it has ever been. Many corporations pay little or no taxes. My colleagues at the Institute on Taxation and Economic Policy have a tax tracker on our website. We find that 280 companies avoided $137 billion in taxes in 2025, just so on their 2025 profits just so far. So, you got these huge corporations like Tesla paying zero, but this can be fixed. We can fix it by putting in place a global minimum tax. That was something that all of the Democrats except Joe Manchin wanted and that we didn't get under Joe Biden, but that would really get rid of corporate tax avoidance. And we can fix it by getting rid of these pass-through loopholes that let huge, enormous entities that have all of the characteristics of corporations not pay the corporate tax. So make sure corporations pay. That'll be it will increase the fairness of our tax code. It will fall mostly on very rich people, and it will raise a lot of revenue for all of the things that Americans need: healthcare, education. These are things that are much lower cost in other countries because they raise more adequate taxes.
So, Amy, let me ask you, you said there are these loopholes that corporations exploit. Give an example of one that you think is the most costly to our tax system?
Yeah, corporations hide enormous profits overseas in tax havens like Bermuda and Barbados, and it costs us an enormous amount of money. And we had a fix to this that 165 of the largest economies in the world were ready to sign on to and did sign on to. And a bunch of our trading partners started implementing that, but we didn't get it through when Biden was president, and then Trump really undermined it. So I think the next time we have a president and Congress who are willing to fix the tax code, that should be the first thing they do, is to put in place this global minimum tax, stop corporations from hiding their profits in overseas tax havens.
So how would a global minimum tax work? Because in my mind, I'm thinking, if there's a way to move money around to avoid paying taxes, any sort of rational corporation is going to do it. When you close down one loophole, another one opens up. What is this global minimum? How would it work? How would the U.S. enforce it?
Yeah, that was what was so great about this structure, is that all of these OECD nations, that all of the large wealthy economies, large wealthy democracies agreed to do this. And the way it would work is that if other countries impose really low corporate taxes, you could make up for it in the other countries in which these corporations want to operate. So it was a really elegant structure, and it is a really elegant structure. And what is going to happen is that these other countries are going to start putting it in place, and the American people are going to lose out on the revenue, while Germans and Brazilians and Japanese families are going to see the revenue invested in their countries from avoidance that U.S. corporations are doing here, because these other trading partners are going to be able to put it in place in their countries.
Yeah. And Amy, one thing you've also said is that some large corporations use parts of the tax code that is meant for small businesses. Could you explain that, and how does that happen?
Yeah. So there are something called pass-through businesses that pose as sort of small businesses, but really, like Bechtel, these enormous Fidelity, the Trump Organization, are some examples of enormous pass-through businesses that have millions, billions in profits, but they are able to get into this part of the tax code that's meant for small businesses. And we can't even audit or really understand how they're doing it. It wasn't the way it was originally intended, but over time we expanded. So now the United States, there's only a couple of countries in the world that have more of their businesses organized as pass-through entities than the United States. So if we close this loophole and just make them pay the corporate tax, we'll be able to collect enormous amounts of revenue that can give the American people what so many other countries around the world kind of consider to be part of their basic social contract.
Yeah.
Free healthcare, low-cost college, free childcare.
Adam, let me ask you a couple questions building off of Amy's proposal. One, we talk about closing down loopholes. Mm-hmm. Do you think you could reasonably close down all the loopholes without creating new ones? Second, would this incentive, if you did close down the loopholes, would it incentivize corporations to disinvest or to offshore? Your thoughts on that?
These are the exact two questions that I think we should be asking. On the global minimum tax, we have 3 corporate minimum taxes already in the tax code. They mostly just lend additional complexity and compliance cost, and all of them have these sort of holes that ultimately are added to these systems for good reason, because if you make them too stringent, you're simply just penalizing the job creation, investment, and activity you want to happen here in the United States. Even the global minimum tax that would have been imposed by the OECD and a bunch of European countries that Amy was mentioning had a whole bunch of these holes in it, where countries could incentivize companies to move to their country with direct subsidies and refundable tax credits, and a whole bunch of other margins on which competition for lower rates
was that a problem
of
political will, or was it a problem of you just can't design a law that would stamp out all these little fires, in your opinion, Adam?
In the case of the OECD, it was political will, but I don't think we can divorce the two. You need a system that can get buy-in, and this system didn't meet that threshold. On the question of getting out of what are the economic effects of such a proposal, I think it's most important to remember that the corporation itself isn't paying the tax at the end of the day. Economists talk about tax incidents, who ultimately bears the economic cost of the tax. And this is ultimately going to be either the workers who the business employs, the consumers who purchase the things the business is selling, or the investors in the business. And there's a whole deep economic literature on which of these three factors ultimately bears the cost. And in my view, it's mostly workers. They're the thing that that can't move. International capital can move to other countries. Businesses can move. Consumer prices are ultimately set in broader markets. And so workers, in the form of fewer jobs and lower wages, ultimately bear the burden of these business taxes. And that's why we want to keep them as low as possible.
Daniel, your quick thoughts on that. Do you think that's who would bear the ultimate cost of any sort of increased corporate tax?
Avi, that is a huge question. So as one of those academic economists who has contributed a little bit to this literature on where the incidence of the corporate tax falls. So if we raise $1 of corporate taxes, who winds up paying that? So it can show up in higher prices, it can show up in reduced investment and reduced jobs, that sort of thing. I think it's important to remember the context a little bit of what has happened with corporate tax rates around the world since the early 1980s. Corporate tax rates have had what is called, what's often referred to as a global race to the bottom, as people have kind of lowered tax rates from in the realm of 40% today in the realm of 20% and maybe a little bit below. What that tax competition does is it says capital is going to move to the lower tax place, and that capital movement can also impact workers and whatnot. So I think one of the things that is maybe not quite appreciated in this context and the discussion so far, which Amy and Adam have done a great job covering, is that the global minimum tax is about changing the outside option for the capital in the US and saying you can't necessarily move to, I'm going to name a country that is sometimes thought of as a tax haven, say Ireland.
Right.
And
you're setting a floor.
Yeah, you're setting a floor. And so that floor is going to say everyone can raise at least this much revenue off capital income. That rate, of course, was going to be relatively lower still than labor or wage rates in the US. But the idea is about this international substitution and how important is this for the other agents in the economy as well, particularly the workers. I could talk more, but
No. Thank you so much.
And by the way, I want to bring in a caller because our question of the day to our listeners is, what would be your big fix to our tax code? The number is 888-477-9499. The email is studio2@WHYY.org. And Beth from Cheltenham has a big idea. Beth, you're on Studio 2. What's your big fix? Okay, I think we don't have Beth.
That'll fix it.
That's all right. So we're going to move on to Adam Michelle's big fix. Your big idea for this first round is a national flat consumption tax. Lay it out. What is the problem you seek to fix, and lay out your solution.
Yeah, so this is a sort of rip it all out from its roots and start over proposal, and it would fix, in my view, the major problems we currently face. Our tax code is overly complicated, as you laid out excellently in the beginning. It has too many credits, deductions, carve-outs, which ultimately treat similarly situated people differently. It adds about $500 billion of annual compliance cost, and then the system is also economically distortionary. It layers multiple layers of tax on savings and investment, and ultimately encourages people to consume more today and save less for the future than they would without a distortionary tax system. And so if we take out the entire federal tax code and replace it with a single rate, low flat tax on ultimate final consumption through a wage tax and a business tax that allows full deductions for wages paid and investment, you get to this consumption tax base, which is one of the least distortionary ways to raise revenue in a way that is fair, treating similarly situated people similarly, and has this tremendous economic benefit where it's not discouraging investment, which is the lifeblood of long-run economic growth and wage game.
Yeah, and could you just give us an example? So give us an example. Use $100. Somebody get paid $100, and explain how this would change for a normal person.
Yeah, so you earn your wage, you earn $100. Each American would receive an exemption, and effectively a 0% tax rate on some initial piece of your income. The current standard deduction is a good way of thinking about that. It could probably be higher. And then you pay one flat rate on everything you earn over that. No need to think about additional itemized deductions or tax credits or all the complexity that comes with those systems. And then businesses would face one simple system that mirrors that at the same tax rate, allowing full deductions for wages paid and investments made. And that gets you to that non-distortionary consumption tax base.
Now, in this scenario, the poorest person pays 5%, the richest person pays 5%, or whatever the number is, right?
Correct.
How do you adjust
for
is that
for living standard or for sort of what
above
your
a certain
basic
amount,
needs
above
are.
a certain
Correct.
amount. Yeah. So how would you sort of a lot of people would have a problem with that just on an sort of an equity perspective. There's people that have way more money than they'd ever need to meet all their basic needs. Shouldn't they pay more? Now, I think you're arguing that there is something distortionary about that it disincentivizes people from building wealth. Is that the idea? Or like, how would you defend what might feel very unequal or unfair to folks on the surface?
Yeah, so I think it's the fairest system. It's treating everyone the same. It's saying if the tax rate is 20%, everyone is paying 20%. Whether I earn $100 or $1 billion, I'm paying the same 20% of what I earn. And that is, I think, that is true equity. That's treating everyone similarly. And many states at the state level have moved towards this flat rate system because it's getting rid of the complexity and treating everyone the same, so you can't game it. There's also the economic benefit. As you have higher marginal tax rates, if you increase tax rates, the more you earn, you're creating disincentives, not just to start new businesses, but also to invest in more years of education and to work longer hours, to put in the type of effort that moves you up those income brackets. And we see this across countries. Often people think that European countries, that people take longer vacations there simply because they like taking more vacation, or there's some difference in work ethic. Much of that difference can be explained in wage tax rates. When the government takes a larger share of your next dollar earned, you have a smaller incentive to earn that next dollar. And so if you can bring rates down and treat everyone similarly, you are also encouraging additional work, which is necessary for sort of long run production and economic prosperity.
So Amy, let's get your reaction to this. Simplifying sounds good. I don't want to spend hours and hours trying to figure out how much I owe the government. Do you think this simplification would be worth the trade-offs in terms of taking the tax rate and saying it's not going to be progressive, it's going to be flat? Your thoughts, Amy?
Yeah, the reason that our tax code is complicated is because wealthy people and corporations have demanded tons and tons of exemptions. And what Adam is suggesting would in two ways make sure that regular working people pay more of their income in taxes, and that the very wealthiest in corporations pay less of their income in taxes. So it really makes no sense whatsoever. So he's saying that in two ways. One, he wants a flat rate so that you wouldn't pay a higher rate when you earn more. I think we need to ask ourselves when we look at whether a tax is fair, is it your billionth dollar or is it your 10,000th dollar? And I think that we all would agree that those of us who earn a lot more money, especially from wealth and not from working, should be they're getting more out of our system and they should pay more into it. And then the other thing that he's doing is shifting taxes from earnings to consumption, or from income to consumption. That also is a way of making sure that lower income people who have to spend most of what they earn have to pay a higher rate. So in all kinds of ways, he's basically suggesting a tax code that would demand far less from those most able to pay and would demand more from the average American. I think it's a huge mistake.
Yeah.
Yeah. How would this?
I would like to just add one
But how would this
additional
help? How would
point.
this help the person sort of, or how would this someone who's making very little, who does need to spend a lot of their income just to meet their basic needs? How do you think this system would help them, Adam? Because I could see how it would hurt them in terms of the percentage of what they make going toward taxes. But what's the benefit for them?
The benefit is there's up to a living standard, your income is exempt. So you don't pay income tax on sort of basic living necessities. And Amy said that the tax code is incredibly complicated because corporations and billionaires have asked for these carve-outs. That is 100% correct, but it's not just at the top end of the income distribution, it's also at the bottom end, whether it's that we have something like 6 different definitions of child in the tax code for the child tax credit and the earned income tax credit. All of these programs are incredibly complicated and make tax paying arduous for people not just at the top, but also at the bottom. So the simplification of the system also benefits people at every single level. And that's the being able to do your taxes on a postcard is a benefit mostly for people whose time is scarce, who are taking that second job, who don't want to figure out how to do it on TurboTax. So it's not just an exemption for lower income people for living standards, but also simplification for everyone.
And we're going to put a pin in that. And we'll be right back, Adam. We're talking about taxes today, and our question of the day is, what would be your big fix to our tax code? Give us a call, 888-477-9499. And by the way, Daniel will give you a chance on the other side of the break to respond. We'll be right back. This is Studio 2.
Take all of that activity and take small increments of that activity and allocate it toward the public use.
Yeah, by the way, I wanted to get Adam and Amy's thoughts on the land value tax. Your thoughts on this, Amy? Any thoughts?
Yeah, I have no argument with the land value tax. I think that there are lots of different reforms that we can make to local property taxes that would raise more revenue and allow us to tax property more efficiently and have sort of better urban planning. I just want to say something about Dan from Ardmore. I mean, that's a great question, right? Is inequality good for the economy? Inequality is really bad for the economy because it means that a small number of people are hoarding more of the resources and we have less to invest in, like, tomorrow's Benjamin Franklin, right? Like, if we're not able to invest in our schools, in our healthcare, in making college affordable, then the economy is not as efficient as it should be, because it means that we're not able to get the most out of all of our people. And we have an economy that has grown much more unequal and it's very inefficient. So I think Dan from Ardmore really made a great point in his call.
Yeah, any thoughts from you, Adam?
On this inequality point, most measures of inequality are static measures, and I think what's most interesting is looking at generational mobility and the ability to make more out of your life. If you look at something like the list of the Forbes 400 richest people in the country, there's like 5% of that list is the same as it was in the 1980s, which tells you the United States is an incredibly dynamic place. And so we want to be looking at over time, how are people becoming better off? And so most of the proposals to increase taxes on the high end, tax capital income or wealth, are really about just knocking people down a peg from the top. And I think we should be thinking about solutions that are really helping everyone become wealthier over time. And so that in that sense, we want taxes that are like that have features of this land value tax that we've been discussing, taxes that are non-distortionary, that are not hitting wages or investment, that are easy to move and do create these big distortions. So in that sense, I do think that the land value tax is a great example of the types of taxes we should be talking about, rather than ones that are hitting things that are easily manipulatable, that are easy to manipulate, like business income and wages, especially at the top end of the distribution.
Okay, well, we're coming up on another break, but it sounds like there's some interesting intellectual sort of mesh point happening here on the land value tax. So perhaps something to pick up another day. Let me read a couple more comments. David Bagan on YouTube says, we all pay a flat tax at Target for merchandise. Why can't we also pay a flat income tax? Maura Lacates on YouTube says a big help would be to tax religious entities, churches, etc. are tax exempt and they don't need to be. Okay, so we have a few more ideas to run through very quickly on the other side of this break. We'd love to hear from you about your big fixes to the American tax code. Studio2 at WHYY.org. 888-477-9499 is the number. We'll be right back.
And welcome back to Studio 2 here on WHYY. I'm Cherry Gregg.
And I'm Avi Wolfman-Arent. Today, with tax season in full swing, we've been talking about why our tax system is so burdensome, overly complicated, and inefficient. It's our Big Fix Hour, and we have three guests with us proposing possible solutions. Let me reintroduce them. Amy Hanauer is Executive Director of the Institute on Taxation and Economic Policy. Adam Michel is Director of Tax Policy Studies at the Cato Institute. And Daniel Garrett is Assistant Professor of Finance at the Wharton School at the University of Pennsylvania.
Yes, and for our listeners at home, on the road, or elsewhere, we want your ideas too. Our question is, what would be your big fix to our tax code? The number to call is 888-477-9499. The email is studio2 at WHYY.org. And our YouTube and Facebook streamers, you can drop a comment in the chat. And so we're going to move on to round two of the ideas from our panel here. Amy Hanauer, your second big fix idea is to tax income from wealth the same way we tax income from work. Break it all down for us. What is the problem and your solution?
Yeah, so I mean, the main wealth of regular people is in their homes, and we do tax homes through property taxes every year, as Dan was talking about earlier. But we don't tax the main sources of wealth that higher income people have. And we have a huge bunch of tax breaks around capital gains income. So first is that we don't tax the wealth. We only tax the income from that wealth. So we only tax it at the point of sale. And second is that even at that point, we tax it at a much lower rate than we tax income from work. So the top capital gains tax rate is 20%, whereas the top earned income tax rate is 37%. So we want to, and then what happens is that people are able to pass on their assets without ever paying any taxes on them. They can pass them on to their heirs, and their heirs inherit them at the new value, and nobody ever pays any taxes on the growth in income on that wealth. And that's how people like Bezos are able to just gobble up a larger and larger and larger shares of the economy.
And then, so here's a comment from Chris in Allentown. Please discuss how the ultra rich avoid paying taxes by borrowing against their assets. Because the obvious sort of, I guess, critique of that, what you laid out there, Amy, is that, well, you can let money accrue value in the market, but you at some point have to take it out to use it, and then you pay the tax on it. I think what Chris is saying, what I imagine you're going to say, is that there's a way around that.
Yeah, you would think, right? You would think. But the fact is that very wealthy people like Elon Musk or Jeff Bezos can borrow against the value of their assets, and they can purchase anything that they want with that borrowing. And then they never pay taxes on it until they pass it on to their heirs. And their heirs don't pay taxes on it either, because the heirs inherited at the new value. So it just makes a lot of sense to close these loopholes. They are not available to regular people. They are available mostly to the uber wealthy. And it distorts our economy and leaves us with the incredible inequality that we have, that not only means that a small number of people are gobbling up more and more resources, but it also means that they're like controlling our democracy. They're controlling our main sources of information. And it just is very, very distortionary.
And we only have we have to move pretty quickly through this. So I want to give Adam about 30 seconds to critique Amy's big idea.
Well, I think we do want to treat all sources of income similarly. And that's why I originally proposed a consumption tax, so that we tax the people when they actually consume the income, whether it comes from wealth or from wages. But what Amy is proposing really just increases taxes on savings and investment for ultra wealthy people and average Americans. And this will have dramatic impacts, meaning that we have less investment in businesses, in new tools, and the innovation that we need to stay ahead in our modern economy.
So you're saying it would disincentivize people from putting money in the stock market, essentially, and then through that method investing in companies. And I believe your second idea, Adam, is to create an incentive for people to invest and save their income. So let's lead right into that.
Yes, yeah, you're exactly right, and wealth is not just gold bars in the back of someone's closet. Wealth is in ongoing businesses, in lots of closely held businesses, in Amazon, in SpaceX. And if you tax that stock of wealth, you're actively taking a bite out of these companies that employ millions of Americans. The way that most Americans invest in the stock market, in companies across the country, are through things like their 401k, their IRA, their 529 plans for education. And so my second big idea is simplifying this system. We have over a dozen of these tax preferred accounts that basically just remove capital gains and dividends taxes on investments, and instead allow people to put their savings in what's called a universal savings account. It wipes away all the complexity where you have to choose if you're saving for retirement or for health or for education, and instead says we're going to get the government out of that decision and just allow you to save for whatever your life's priorities are. And so it's a simpler system, allowing more Americans access to something that is mostly just used by wealthy people today, because of the complexity and because of the requirement that you have to lock your savings up for a specific purpose. These accounts have been tried in the UK and in Canada, and they're incredibly popular. They're actually more used by lower income and younger people because of this flexibility. And so I think it's an incremental step in the right direction, both simplifying the tax code and removing some of this distortion where we double and triple tax savings and investment.
Yeah, so Amy, is this not a good idea for trying to get people to save more? Say you can put it in an account. It doesn't have to be for retirement. It doesn't have to be for college. You put it in an account, it can grow, and you're incentivized to invest in our economy and to save money. What would be the downside?
Yeah, I mean, I think that what we really want to focus on in our tax code is how can we have more of the enormous wealth that's being captured by the 1%? How can we have that more broadly shared among all of us so that we have it to invest in healthcare, in education, in college affordability? And the fact is that the way that the US economy works, and the way that our tax code works is that we reward corporate wealth, we reward individual wealth, and we reward super, super high incomes. And that just detracts from our ability to have an economy that works for all of us. So, I'm for people having vehicles to save, but most of those vehicles have been really only usable by those with a lot of disposable income. And what's increasingly happening in the United States is that most people don't have a lot of disposable income, and the uber rich are consuming more and more and more of our income. So I think what makes more sense is tax corporations. 70% of Americans agree with that. Tax income from wealth. Both of those breaks for corporate income and for wealth go overwhelmingly to the top 1%, and instead have a tax code that works for all of us.
Yeah, by the way, James from Chester County says, one thing I would love to see is corporations that abuse the safety net to supplement employee income blocked from any sort of tax break. And Daniel, did you have any critique for Adam's idea?
Yeah, so I just wanted to comment quickly on so Adam's idea on savings accounts, I think is broadly a very good idea. I don't think it's going to raise revenue. And so when we're thinking about, I wanted to just put our conversation in the context a little bit of the current deficits ongoing. So last year in 2025, the U.S. had a $1.8 trillion deficit, which of course, that's trillion with a T, is a very, very large amount of money. That's relative to kind of the total spending was about 7 trillion. So we only raised 5.2 trillion. I just wanted to say there are already taxes in what we're doing, and these are implicit taxes on the future. That is to say, if we're spending money now that we do not have and borrowing it, we, of course, there are I will say there are some interesting arguments here in monetary economics about exactly how we will pay it back in the future. But it's almost certainly going to happen through some set of taxes that we have today. And so I am going to, I think it's important to focus on what can actually really raise revenue if we're going to really think about structuring the tax code differently.
Before we get to your last idea, I do want to bring in Mark from DC, who I think we tried to get on earlier, then it dropped. So Mark, second time, we're going to say is the charm.
Yes.
Mark, you're on Studio 2.
Thanks so much for taking my call. I just was going to point out, it feels like much of the focus has been on the cost of taxes and not what taxes actually benefit. And it strikes me that the beneficiaries of our tax system, namely the things that we buy with our taxes, the safety, the legal system, the military, and all these things, the biggest beneficiaries of those are the wealthiest. The wealthiest corporations succeed in part because we have this stable economy and this stable infrastructure. And it seems like what Adam and the Cato Institute in general seem to miss is who actually benefits from our system and who benefits the most. And frankly, when we look at the economy, the biggest beneficiaries are the wealthiest. And that, to me, is an argument for a more progressive tax system.
Thanks, Mark. Real quick,
Thank
Daniel from University City. Keep it brief, but we'd love to bring you onto the show because this hour is about people named Daniel. Daniel, go ahead.
A lot of Daniels.
So many Dans and Daniels. Thank you for having me. I think about how I, as a Philadelphian, would prefer to take SEPTA and go to public parks over pay for private things all the time. But I am willing to pay extra for these things so that other people do not have to pay for them or have to pay less. I would gladly pay $4 per SEPTA ride instead of $2.90, which is the current rate, because I don't like driving on Philadelphia streets. I would gladly pay extra to make potholes go away. I wish there were more ways to easily and dynamically participate in the tax system and have it be a source of civic pride rather than an annual complicated obligation.
Wow. Thank you. That's Daniel from University City who says he's happy to pay more taxes, right?
I like that.
Opting
Didn't
in.
see that coming.
I love that. And so, Daniel Garrett, you're going to be presenting our final idea for our Big Fix series here. You're talking about carbon taxes.
I am.
Lay it all out for us.
So carbon taxes. A carbon tax is just a per ton fee on CO2 emitted. It's usually going to be paid by upstream producers of fossil fuels, not consumers directly. But of course, this does two things. So this is a distortionary tax. But
it aspires to be distortionary.
It aspires to be distortionary.
Yeah.
So I'll say my two big ideas, obviously I chose here because in the context, we usually think of them as fixing some behavior. I want to highlight they can also raise revenue. So a carbon tax, of course, is It's the idea is we will get slightly less carbon over time.
Yep.
It will incentivize investments in other non-carbon-based energy sources and other non-carbon-based manufacturing in general. And of course, it'll raise a lot of revenue. Now, I will say the numbers that the U.S. has been thinking about so far for carbon taxes are quite low. So the numbers, and just to give you the ranges, people often think about this kind of $25 per ton is what the Treasury has been forecasting is what our carbon tax could be. You should note the Swedish carbon tax right now is closer to $138 per ton. So you can make these things quite large. At the $25 level, it doesn't raise that much money for the U.S. It would raise more like $80 billion a year. But this is a thing that we could expand. And I think, the real benefit here is we can tax and distort some behavior when that behavior is damaging to other people.
Right. But there would be, by design, some short-term pain. So if you're a firm that produces a lot of carbon and you're hit with a big tax, you might shrink your labor force, you might automate more. Like there would be, and that would be the intention of this.
That would be the intention, yes. So the U.S. economy is large and it is vibrant with people moving across sectors all the time. Yes, the carbon tax would hurt in the short run. And this is kind of where we think, if you think that people will often think about cap and trade or the carbon tax as kind of having the same economic effects, but not the same revenue effects for the government. So of course, if you have to actually pay a tax, you have to give up other things you were doing. You may have to shrink what sort of, let's say, oil and gas exploration you were doing, or you may have to say try to be more efficient with the way in which you're running your refineries and maybe laying off people. That is absolutely partly a what we'll call a fiscal externality. But it would be part of the point, and it would also raise revenue that we could spend on other things. I think those externalities are easy to solve.
I bring in now a quote from economist from Harvard, N. Gregory Mankiw, who says a good rule of thumb is that when you tax something, you get less of it. And that's exactly what you're aspiring to do with the carbon tax. Real quick thoughts, Amy, on a carbon tax as we get ready to close out the hour.
Yeah, I mean, look, our planet is boiling over, so anything that we can do to reduce the emissions, global greenhouse gas emissions, I think is a good idea. I have slightly other ways that I might structure it, but I am for making sure that we kind of reduce our contributions to global warming, so I applaud that suggestion.
And we only have about 30 seconds left. Adam, your thoughts?
Yeah, the key question here is what is that externality? What are we trying to price in so that the distortion that the tax is creating is actually meeting the problem you're trying to solve? And the government, since the Obama administration, has said that cost is anywhere between $3 and almost $200. And so it's just the problem is not well defined enough to levy a tax on something that is so essential to such a large portion of the American economy. So I'd rather raise revenue other ways.
Well, your guys' insights were essential to our conversation today. Let me thank all of you. Adam Michel, Director of Tax Policy Studies at the Cato Institute. Amy Hanauer, Executive Director of the Institute on Taxation and Economic Policy, and Daniel Garrett, Assistant Professor of Finance at the Wharton School right here at the University of Pennsylvania. Thank you all for your insights today on Studio 2.
Thank you so much, Avi and Cherry.
Yes.
Thanks for having us on.
Yes, and
Appreciate it.
Yes, and thank you, of course, to our callers, the ones who got through and the ones who didn't. We appreciate you, and we hope you try again.
We love all of you.
Yes, and of course, thanks to our producers, Debbie Builder, Andreas Copes, and Hazel May Bryan. Mike Schiffler and Al Banks engineered today's show. Our executive producer is Kevin McCory. From Studio 2 here at WHYY in Philadelphia, I'm Cherry Gregg.
I'm Avi Wolfman. Aaron, we'll talk to you tomorrow. Tomorrow at noon, Born in the USA. As birthright citizenship heads to the Supreme Court on Wednesday, we discuss what's behind the 14th Amendment. Polls show that whether you are in favor of the practice heavily depends on your political affiliation.
And with his executive order, President Trump tries to challenge citizenship in the United States. And while a decision is not expected until the middle of the year, the fiery debate of who is American remains underway. We learn about the arguments and the history of birthright citizenship tomorrow at noon. Coming up next, we have Here and Now.
Supporting WHYY, the Philadelphia Speaker Series.